Good afternoon. Ira Epstein of Linn and Associates with your metals market wrap-up, and this is for Tuesday, the 7th of May, 2019, getting on to 2:15 in the afternoon, Central Time. If you take a look, basically another down day, and these are hard markets to trade right now. This is not for the uninitiated futures trader. You've got to keep your stops tight. You get whipsawed back and forth. Momentum's changing on you, and on a moment's notice, you can get a complete change of everything, because what we're really trading is the potential for this trade war to take off to another step, or at the last minute does. The trade delegation, and really what I'm talking about are presidents, Trump and Xi out of China, do they really behind the scenes say enough's enough? You see what we can do, we're hurting you, we're hurting ourselves, to both of them. They're both saying that. Let's resolve this issue. I'm not saying calm heads are going to prevail. Don't get me wrong. That's not what I'm saying. I'm saying that's what you're trying to trade, and that's so difficult to do. It's different than a trade issue in the market. No, I'm sorry, than a Fed fund issue. When the Fed makes a move, it's like the granddaddy. Whether they're right or wrong, they step on the market, it does something. Trade is completely different, because at the end of the day, you might get the Fed to step in and do something with interest rates. That happened yesterday, whether you know it or not, in China. From Sunday's tweet by President Trump, China decided to lower the reserve rates to especially rural banks that are servicing smaller businesses and medium-sized businesses in a three-step package that starts May 15th and finishes up on June 15th, actually July 15th. It's 3 steps to it. So when we look at the gold market, it's found some footing. It's not saying it's bullish, but it's found some footing. This 1271.90 level, the market has now bounced away from it about $15, but I'm also watching that you're getting higher lows, higher highs on a closing basis. It's not terrible. It says it's found some footing to it. When I look at this whole area right here, I think you can see that the market seems to be in a circle, just going back and forth in that trade area. It is got a pattern of lower highs, lower lows, but because you're going to settle today, and I know the settlement price because I'm Aladdin, 1285.60. Remember, they closed the markets at 12:30 p.m. Central Daylight Time, so I can get a chance to look at it before I do this. If you take out 1287.40, you're going to change the pattern here. You're going to get a pattern that could go to higher lows, higher highs. I'd be keeping my eye on that. Also, you'd be over the 18-day averages that happened. So the bulls seem to have, for the moment, wrestled control out of the bears' hands, and this is the first time we're getting a settlement over that 18-day average, where the pattern can also change on you at the same time. When we look at moving averages, the 100-day average is up at 1301.70, but crashing down to find resistance, and it's what the market's going to have to run into if it's going to go up at all, is that first Bollinger top here, and that's going to drop down again tomorrow. Right now it's dropping at about $7-8, so something in the high 1280s, 1290 level might be where this market ultimately finds its first resistance level. When you look at momentum, it's up. So here's what we've got. We have a market that's now got divergence all over the place. We've got the swing line down. We've got bias up because you closed over the 18-day average of closes, and momentum has been pointing up. So even without today, I had mentioned divergence. Even though you had these lower highs, because I would have had this arrow back here yesterday probably, lower highs, lower lows, and resistance here, I'm watching divergence. I believe that momentum leads price, not price leads momentum, and that's what I think is going on right there. In the popular ETF GLD, just like the futures, the first close over this number. Now, it's not as pretty a chart and easy as one to turn up as this futures chart. You have to get a bit higher at 121, what is that, 55. You have to clear that number, and you're immediately going to run into that upper Bollinger Band and the 100-day average. So this might be an area, if it gets there, that you end the down leg. I'm not convinced on that chart it's going to start an up leg. It won't turn the swing line up either. In GDX, you negated the downtrend today. You had coming in lower highs. 2059 is an important number. You took that out, and at the same time, I'm looking at the red line it's up over 22. Now, admittedly, we are not at the close. I'm recording this now about 217, 218, whatever the time is. But with that, if it stays lost, I would not be surprised to see price and the 18-day average make a run at each other. So I'm looking at that market as not something that I'm any longer interested in the bear side of. In the gold-silver ratio, and by the way, I've changed here to the June gold, July silver. May just doesn't seem like what we should follow. You keep coming down to this 18-day moving average of closes where the support is. I call that the line in the sand. Now, as long as the market stays up and over that, the bias is for gold to be gaining on silver, so it costs you more silver ounces to buy an ounce of gold. Get under it, it flip-flops. Therefore, when I'm looking at silver, you know what I'm going to say. It's still in its downtrend. Unlike the gold, it's still closing under the 18-day average of closes. Getting, though, over 1499.50 would give the market upside bias. The swing line would turn up, and you've already got momentum that's been turning up. The bears are under the gun in this market as well. In the copper market, what you've been fighting at isn't the 18-day average. You're fighting at the 100-day average of closes. You see that right there? You're oversold. You went down again to the Bollinger Band. So if we take a look at yesterday's close, we had a dramatic day, a 10-cent range in the market. That's huge. It's just monstrous in the scope of things. The market stopped in the neighborhood of the 100-day average. If it fails, because you've hit that number, then the Bollinger Band could become the support again. And that's what the market did. Is it trending? No. It is oversold, trying to figure out what to do. Still has downside bias, but a higher high, lower low. And you know that this market's directly looking at the Chinese trade because China represents 50% approximately of the world usage of copper. When we come to the platinum market, we've got a higher high, lower low, and I realize that when you get under these Bollinger Bands, everybody gets excited. It's not the place that I tell people ever, and I want to use that word, I don't tell people to go short under a Bollinger Band or long over it. Once I learned about Bollinger Bands, it's not a secret. Just take a look. That's why it's a 95% algorithm where you're going to trade within those bands. So now you're popping back up. You also don't have a trend. All you've done is a pop. The resistance point is the 18-day average. I don't know if you'll hit it or not. You got close, and then the market fell apart, down $9.9. In the palladium market, if we take a look at yesterday's action, oversold. You still have the lower high, lower low. If it wants to continue lower, the Bollinger Band becomes a likely support zone because you can see the bands, the black lines, are going sideways. You didn't quite get there today, but you're certainly trying. In the dollar index, the line in the sand, that 18-day average, which way do you go with this? This is what's hard. I can make an argument that you've got the lower highs, lower lows. You're refusing to settle under that number, and you're having an outside day to the upside, which means you took out yesterday's lows and highs, couldn't stay under that number, popped back up. Difficult chart. I wouldn't know what to call it. Momentum's gone flat, bias up, swing line down. Everything fighting each other. As you can see, as we're talking, the stock market hasn't, like yesterday, put on a bounce just yet. It was rather dramatic in the last hour of trading. You know, one of my tools that I look at when you get markets that stretch out the way that these are pivot points. This is a formula that's been around a long time. And the formula looks at the previous day's high, low, and close. From that, you figure out, you're looking at those numbers, resistance points above the market, there's the pivot, and support below it. You'll normally, most people use 2 levels of resistance, 2 levels of support. Can you use more? FX traders typically use 3, sometimes 4. So they'll look at it in a little different way. But the idea is you're selling into resistance with timing going with it. Most people don't use oscillators for timing. I do. And I put it together in a 3-part series for you that is all video, and you see how it works. The first video is going to tell you how the formula is computed. Your charting service will do that for you anyways. The second is how you plot it on your charts using different colors if you want. And the third is how to apply the timing to it. It's a free series. If you like it, either call my staff, you can go to our website, sign up for it as well, or you can click right up here. If you're watching me on YouTube, it'll take you there. I'm Ira Epstein. Crazy markets, difficult times to trade. Remember that. You have a good day.